Okay, continuing on, part two of the taxes and other revenue section, talking about individual income tax, 7A on your worksheet is what you're getting. So again, taxes on your paycheck or individual. This is a progressive type of tax, and it's really the largest source of federal revenue. Personal exemptions. So the taxable income then is that income less exemptions and deductions. Um, Deductions are taken on things like medical care, interest paid on mortgages, charitable donations, etc. So deductions are taken on things like medical care, interest paid on mortgage, energy credits for conserving energy. Um, you might want to write down the deadline that has to be filed by April 15th. Most people have those taxes withheld out of each paycheck, kind of a pay as you go system. Because if you didn't, you get screwed at the end. When you get your April 15th, you don't want a big tax bill at the end. It's why some people, have too much held out. Like for you guys, for teenagers who don't have any personal dependents or to declare, it's weird. It's best to declare zero on your income, zero on your withholdings, and that way, because you don't have any dependents, so you don't want too much withheld. Um, you don't want not enough withheld, because at the end of the year you've got nothing really to declare in terms of other than yourself. So you don't want, and you're usually not making a tremendous amount of money, so it doesn't because it's progressive. It doesn't kick in sometimes if you make too little on a paycheck, if you didn't work a lot that week or something like that, because teenagers' work schedules are so inconsistent. So anyways, it's probably best to declare the withholding of zero, so that way at the end, when 2000 in at the end of the tax year, you're not having to pay. Then you're looking at corporation 8B, number 8B, or excuse me, 7B, 7B, the corporation income tax, corporate income, taxes on a corporation's income, total revenue minus total cost, total revenue minus total cost before taxes are paid. So total revenue minus total cost before taxes are paid. And then you've got, and this should say number 7 here. Let's just flip that over. Delete. Come on. Delete that. And we'll say that that's this should be number 7B, actually. 7B, corporation income tax. And then this should be 7C. 7C, social insurance taxes is the third kind, and describing them again. The corporation income taxes are corporations paying on taxes on a corporation's net income, total revenue minus total cost. And this is again another example of that progressive tax. The higher the income, the higher the tax rate. Social insurance taxes are those like the protection taxes for social insurance programs like Medicare, for healthcare for the old age people in retirement. Individuals chip in 1.45%, and the companies that are that are withheld, where it's withheld, the company that you work for or the corporation or the business is 1.45% for a total of 2.9. Same thing with Social Security, 6.2 by the individual plus 6.2 by the business is 12.4% proportional, meaning an equal portion of their income. And another thing you see when your line items, these are line items on your paycheck, Social Security you're paying into, Medicare. These are a lot of these are for your parents and grandparents. Whether you're going to have Social Security or not is another question. Old age survivor disability insurance, that's another social insurance program that people that you pay into. And then unemployment insurance. So if you become unemployed, you are eligible to apply for unemployment insurance, and you're paying a certain amount of taxable wages, 0.8% up to the first $7,000, and social insurance taxes. Again, that's more of a proportional tax there on the social insurance taxes. So number 8 asks you to, again, keeping in mind the more types of taxes, and keeping in mind what they are: progressive, regressive, or proportional. Excise tax. This is number 8. Starting with number 8, excise tax. Not what I wanted to do. I wanted to write in ink. Come on, pen. Number 8. tax on the manufacturer's sale or consumption of goods or services. On this tax on the manufacturer's sale or consumption of goods or services. So such as gasoline, oil, tires, tobacco, alcohol, firearms, telephone, airplane tickets, all this stuff has federal income tax associated with it. Sometimes you see it. If you look closely, you do. So this is regressive. The higher one's income, the lower the tax rate, because it's a lower portion of your income. Everybody pays the same, but if you're making more money, it's actually you're actually paying less of your income. That's 8A. Okay, more types of taxes. Estate and gift taxes. Estate tax is a tax of the asset of someone who dies. In 2009, there was a tax. There was a tax on that when the value of the estate was greater than 3.5 million, and in 2011, that was actually repealed. And what you have also now you have a gift tax, and estate taxes are quite controversial because people are like, it's like a death tax. You're paying money. The inheritor of the estate has to pay a tax to get their loved one or the person who's they're inheriting's money. A gift tax is a tax on a gift from one living person to another. So the first 14,000 is tax free, but everything over that is taxed. So this typically increases every few years to keep pace with inflation. Then the next one you should see these following. So the estate tax is 8B. State tax is 8B on your sheet. And then gift tax should be 8C. I'm just looking down at the sheet. And then custom duties, that should be 8D. 8D. So taxes on customs or taxes laid on goods brought into the United States from abroad. Tariffs, import duties, and so on. If these become too high, though, the government has to watch how they do this, because if these become too high, what happens is that then people become discouraged from bringing in goods, and there's not as much competition. So you have to be careful. While you say, "Oh, we should tax, imports," yes, but there's a competition in trade. Then because then the other country could respond in kind by having taxes on their import duties, and it would hurt our American companies that are trying to ship goods overseas. Then, of course, you have Uncle Sam getting non-tax revenues, Federal Reserve interest, canal, passports, copyrights, patents, trademarks. All these things have fees that go along with them. Lease of public lands, fines the United States issues, both businesses and individuals. The Mint, United States Postal Service, although that doesn't generate a ton of revenue as much as it used to, because the mail services have declined with the coming of the internet. So in summary, what you have is a lot of different types of ways that the federal government taxes, different types of ways that the federal government taxes. So this was on 2 videos. You may want to go back and look at, you may have to stop and look at pieces of them to figure it out, or to get thorough notes.